Welcome to Win the Future, a podcast where we chat with folks who are tackling the most significant challenges our communities face today to make for a better tomorrow. I'm your host, Brett Roster. This is episode number 10. Hello and welcome to Win the Future. I'm your host, Brett Roster, and we are here today with Rich Lopresti, who is the principal at Milestone Asset Management Group and all-around great guy. And Rich, welcome to the program.
All right. Thank you, Brett. Thanks for having me.
Pleasure's all on this side of the mic. Thanks for being on. To start, let's talk a little bit about investing. So a lot of people are at home right now in the midst of COVID, investing online probably more than the average person would in a regular time. Can you talk a little bit about that?
Well, there's definitely apparent trends that are out there that have been accelerated by COVID. You can look to your friends and see what they're doing, what actions and stuff that they're taking. But, some of the investment themes that I've been seeing is everything's online, right? So you're now shopping online. You're now buying everything else online, dinner included. And then retail, the cars, people are buying a lot more cars, used cars, because they don't want to take public transportation. Anything from medical stocks are also taken off as well in hopes of a vaccine. So definitely a lot of trends, but I try to maybe focus more on global trends outside of COVID, kind of a COVID-proof strategy, if you will.
Interesting. So what elements go into a COVID-proof investing strategy?
Well, there's a gentleman that I based my philosophy and thesis on, a gentleman by the name of Hans Rosling. He has written a book called Factfulness, and he's done a lot of TED Talks. He's done a lot of TED Talks on global numbers. So again, with the proliferation of people moving everything online, believe it or not, there's only 4.5 billion people online right now in the world. If we average up, there's about 8 billion people in the world. So a lot of room for growth there. So want to base things on big markets, global markets, where markets are bigger than your local market, right? So the bigger the addressable market is, the more room for growth and business potential for a specific company.
Got it. So obviously we're all at home, we're on our phones, maybe even more so than we're on our laptops. But with that in mind, apps like Robinhood and others are being used a lot. Can you talk a little bit about what that's kind of doing to the market and how bringing in new investors based on mobile usage is impacting certain sectors?
Sure. Well, these investing apps actually have been around for a pretty long time. Robinhood, the one you mentioned, has been around, I think, 10, 11, 12 years. It's not until recently that CNBC woke up to it, and now people are coining the term Robin Hooders, if you will. But there's a lot of other apps that are out there, like Stash and SoFi, even Square, which is Jack Dorsey, founder of Twitter. He started that. That's the Cash App, and PayPal as well. So some of these apps that have millions and millions of users have just basically gave people access to investing in stocks and also cryptocurrency as well, which is another theme that is a global theme as well, which I like. And there's limited supply, and when you have lots of demand and easy access, whether you even have a clue about what Bitcoin is, there's a lot of demand out there for it. So I think these apps have changed the landscape a little bit, forcing some of the older legacy financial players to shift their strategies because these apps don't charge commissions for trades. So the likes of Fidelity and E-Trade and Schwab and those guys have been lowering their trading commissions, which used to be hundreds of dollars years ago, to maybe $9.99 about a year ago, and now it's free as well. So it's also changing the landscape there as well for some of the legacy players. as the effect on stocks, well, they make it pretty and easy for people to invest in companies that these apps put at the forefront of the app. And they're typically companies that they know and use. So it's easy for them to have access to them. So, does it cause volatility? Is it a good thing? Is it a bad thing? I think it's a good thing.
Nice. No, and within that scope, tech stocks are obviously the big headline grabber these days. Can you talk a little bit about what you see in the consolidation of that industry and how it's impacting the market?
Yeah, well, I think the big tech stocks are going to continue to grow as they have been growing. So your Facebooks, your Amazons, your Googles, Microsofts of the world. If you want to go globally, you can look at the Alibabas and Tencents of the world. But these platforms are just going to continue to get bigger and bigger. Obviously, there's some risks with government intervention, but the government just really wants to find these companies and then give them a slap on the wrist and take some profits for the government. But if they change regulation for some of these companies, such as Amazon or Google, for different types of practices of stealing people's identities or buying habits or putting their products in favor of other people's products, it's quite interesting because again, they're doing things on such a large scale that it's they're not going to be stopped. So, for instance, Amazon is getting sued by the EU because of selling their Amazon Prime products. I forget what they call them, the specific brand, but there's a study that's been done that Amazon basically sells 1% of their own products on Amazon.com compared to if you go to shopping, say at an Aldi, it's at 50, 60%. If you go to Trader Joe's, they're selling 85% of their own. So there's a lot of use cases out there for them to argue. So, they're just going to get bigger and bigger. And with the COVID times, last quarter, they spent $4 billion, which was their profit, on COVID proofing their business. So as you probably see, Brett, going outside and everywhere you turn your head, you see an Amazon Prime vehicle moving by you. So I think they're doing pretty well.
With that, so combined with the proliferation of a lot of new investors getting onto these apps and platforms, are there things you would recommend looking out for?
As far as trading goes, or specifically?
Yeah, sorry. Maybe not only look out for on the upside, but also on the downside as folks might be jumping into something too quickly, what to be careful of.
Yeah, well, you definitely don't want to put all your eggs in one basket. I mean, that's something, your mother probably said and her mother's mother said, but that's, tried and true. You don't want to put everything in one given stock or company. I mean, obviously you could say, hey, let me put all my money into Apple. I love Apple. I love the products. I love the services. I know they have different things that are coming down the pike, but you never know if someone could overtake them at some point, or if something changes there within that company. So again, you don't want to put all your eggs in one basket. But you could diversify your portfolio by having a core portfolio. Typically in the past, you would listen to someone like Warren Buffett. He says, invest in the S&P 500. That's what I would do. But Warren Buffett doesn't even invest in the S&P 500. But the index that I would invest in is the NASDAQ. The NASDAQ index, I feel, is more attuned to what's going on in today's world. And I can get into a number of reasons why, but that will give you broad diversification in tech stocks. And it just doesn't mean tech stocks, that the technology that you have in your hand, but technology as far as medical technology is concerned. I mean, everything pretty much is technology. It's newer companies. It's not the old stodgy value companies that are trying to catch up to the new world. An example of that would be Ford and GM. I have one of my clients at Ford. He worked at Ford and said back in 1993, they wanted to develop an EV, electronic vehicle, but decided against it back in 93. And look what they're doing now. They're putting billions and billions and billions of dollars in it's 2020, about 10, 15 years after Tesla. has invested in cutting edge technology for the EV, and they're trying to play catch up now. So the Nasdaq has the companies that are, again, kind of first movers in a lot of these different areas. So I would say use that the Nasdaq as your core.
Nice. And even with, I mean, it's such an odd market in the way that even with Ford's failure to move into the EV market quickly, they have the Mach-E coming out, the hybrid vehicle, and they made, it seems like they made some cuts early on in this year to that have resulted in kind of increase in their stock, right?
Yeah, I mean, the stocks are starting to do well, GM, Ford, those guys, but you want to go broad, kind of get that diversification, and then you can go into different themes. But not only invest in EVs, right? So now you have Ford, you got GM, you have all these different Chinese companies, Fisker and NIO. But you want to kind of lift up the hood literally and invest in the technology behind it. Similar to like your cell phone. Well, what makes your cell phone? It's the cloud, it's the lithium battery. Just like the car. Well, you can invest in lithium and copper. All of these things are going to be needed once there's a spike in EVs. Because I don't know about you, but I don't mind having a self-driving car at all, let alone electronic vehicle, just because it's going to be a lot safer than me driving my car, even though I'm a good driver.
Well, no, and I would imagine in some of these test markets, because less people have been on the road driving to work since people have been working from home, that there's something like 50 test markets across the country. I think Stanford's even one of them, where they've been able probably to accelerate the tests due to having more barren roadways.
The point is to get ahead of the curve as far as the investments, because investments are more forward looking. So, as they say in hockey, you got to skate to where the puck is going, not where it is.
Nice. Like it. Well, Rich, we're going to take a quick break. And once we come back, we'll be here for the second part with Rich Lopresti, who is the principal at Milestone Asset Management. Win the Future is sponsored in part by Connecticut by the Numbers. Hi, everybody. We're back for the second part of episode 10 with Rich Lopresti, who is the principal at Milestone Asset Management Group. Quick caveat here for you that this isn't investment advice. We're talking trends, we're talking education, but not advisement. Within the education realm, can you talk a little bit about the difference between an index fund, an ETF, and a stock for folks who might be new to investing?
Sure. Well, index fund would be an index, so it's going to be invested in a certain area of the market. The most common index is the S&P 500. There's a ticker for it, SPY, but there's also the Nasdaq, which is a QQQ is the index, and also the Dow Jones, which is DIA. But you basically can get an index within an ETF, which is an exchange traded fund, for pretty much any area of the market, both domestically and internationally. You could typically buy an index or an index fund, which is a mutual fund, but mutual funds are kind of the old school investing. That's kind of, mutual funds were invented back in the late 50s, 60s. And the new evolution of that is the exchange traded fund. It's a lot cheaper. It's a lot more transparent. You actually own your cost basis and your positions, as opposed to the mutual fund where you don't. But individual stocks, obviously, it's just you're going to be invested in a company, or if you invest in a company like Berkshire Hathaway, well, you're investing with Warren Buffett. He's investing in multiple companies, so there's some diversification there. But typically, if you just buy Apple or Google or Amazon, you're just buying, obviously, that individual company and what they do, even though they could do multiple things like those companies do.
I hear people talk a lot about how the Lyfts, the Ubers, maybe other companies specifically in the tech space who haven't seen profit margins yet their stock price continues to rise. Can you talk a little bit about just high level why that could be the case?
Yeah, well, the market is forward thinking. So the market is typically ahead of where the trend, or it's kind of predicting where the trend is going. So they're looking at the addressable markets of Uber and Lyft and the technology that they have developed, which basically brought their industry into the next generation, right? So, taxis have been around for forever. I mean, you can kind of hail a cab if you're in a major city or call for a car service. But, what Lyft and Uber do, you just kind of have your phone and someone's going to pick you up. And with COVID, right, so the Uber Eats, DoorDashes of the world, well, now they're also going to be bringing you food. Also, those types of companies with the logistics, because they're basically logistic companies, will also provide possibly the last mile, if you will, of different goods and services that you might have bought from Amazon per se. So there could be a lot of synergies with, say, an Amazon and an Uber, or an Amazon and a Lyft, for them to figure out that last mile, if you will, because I want to click a button now, get a cigar, and have it delivered here in 5 minutes. They were going to, Amazon might use drones, but they might be able to use a Lyft driver as well. So there's other potential or addressable markets for them. Second reason why you've actually seen a spike is because in California, they wanted to make their workers permanent workers. So they would have to give them healthcare, 401k benefits and such. But since they're still classified as temporary workers, there's not a lot of overhead for Uber or Lyft to have these people. They don't need to actually pay them. They're using their own cars and such. So, their workforce can be you, could be me, could be anybody at any time, but it doesn't cost them anything until they get in that car and drive. So, these companies do have debt because of developing their technology, but their business model, if they can eliminate that debt, is just going to be a cash cow.
Got it.
Last piece is, Uber has been developing self-driving cars as well, and they actually wanted to, eliminate the driver altogether. But who knows, what's going to come to fruition there. But it's a race, and again, that's why you stay diversified. If you like the certain space, you buy multiple people in that space. The number one, number two, number three companies.
Nice. Well, Rich, this has been amazing and really insightful, educational. Any last words, thoughts you wanna add?
Well, investing is investing for the longer term. You can't look at your portfolio every day. If you're invested in the right places and spaces and the right themes, and you're kind of skating to where the puck is, you're going to be in a good spot unless something changes. So you got to have patience. If you're going to open a position in a company or a stock or an ETF, don't put it all in one day. You can wait and kind of, buy some this month, buy some next month. It's kind of it's not a marathon. It is a marathon. It's not a quick race.
Rich, can you talk a little bit about the self-driving cars ETF scenario? I know we talked a little bit offline.
Exchange traded funds can give you broad diversification in the whole entire market, but you can actually be invested in subsectors of the market as well through different exchange traded funds. And typically how I like to structure my portfolio broadly, I would like to have broad diversification in the indexes and in the right indexes based on momentum, and then be in the right sectors, but then also the right subsectors and the right stock. So self-driving cars or electronic vehicles or technology. So it's a technology company. So you would be, if you're invested in the QQQs, you would have some exposure to that because, the Googles of the world are in there. But what you want to do is put on another layer of that. You want to be invested in that subsector. And there's a couple different subsectors of that. One is, like I mentioned before, is the under the hood, the lithium, the copper. So there's an ETF called LIT, LIT. So you can actually buy a lot of the miners that are actually in this ETF, or the people who are developing lithium ion batteries in this one ETF called LIT, LIT. And if you want to have more exposure to, a specific company, well, then you could buy a Tesla on top of that, or you can buy ALB, which is Albemarle, which is a big lithium provider. But just buying that one ETF will give you broad exposure. And I don't want to get into politics, but with the new president coming in, this area is even more favorable. And the LIT ETF, I believe, moved from $40 a share to over $50 a share within the matter of a few weeks. So pretty interesting there. So, but there's also a separate ETF you can buy. There's multiple ones that you can buy, but one is called iDrive, and that has a lot of the different ETFs that are individual companies that are in there that are in the space. So it gives you broad diversification there. So just a way to structure a portfolio for maximum optimization and risk management.
Let's talk about a little bit more personal here. So you grew up in Staten Island.
So I grew up in Staten Island.
How did you make your way to Connecticut?
I lived there my entire life until I became, I guess, what you call an adult. I went to school, went away to Pace University, and never went back home to Staten Island and moved to Connecticut. But been in the industry for 20 years. I do have my CFP, Certified Financial Planner. I'm a certified wealth strategist, but I have over 20 years of experience in the industry. Mostly worked in Manhattan, big financial service firms, and then towards the latter part of my early career, I was working for more boutique investment management firms that just kind of dealt with high net worth clients. And for the past few years, I have my own practice here in Milford, 4 minutes away from my house. So
And this time, and with your current position, isn't the first time you're working from a home, right? When one of the boutique firms you worked at was at was it a Brooklyn?
I was in Tribeca, so it was in a penthouse, top 2 floors of a penthouse in Tribeca. But it was also a 2.5 hour commute. But now I'm working. I have my office. I can work from home. I can basically work from anywhere. But the difference is now I'm not beholden to any products or services that a financial firm has to offer. So I've taken everything I learned from the industry, from the different places I worked, and finally have a working thesis, and I'm able to help clients the way that I want to help them. Mostly I deal with folks or assist folks that are approaching retirement, in retirement, still helping them grow their assets, to combat inflation and taxes and all that fun stuff, but also to let them get the money out of the account so they can actually enjoy it. Because money isn't everything, but it's a means to pretty much everything else. So, that's kind of one subset. And the younger subset is, I'm 42 years old. So I work with people my age that seem to have an inkling to invest, but haven't in the past. But, they now have a budding interest to do so. This past year or so, been seeing a big increase in the young entrepreneur, go-getter type of person who's started a family and now wants to take saving for the future more serious.
And Rich, what other domestic trends are you seeing that might be a little outside of what somebody would be seeing in the headlines?
Well, I mean, the way I like to look at investing or themes is you kind of look inward at yourself and see what you're doing. Are you going to Starbucks every day, or, are you using your phone every day? So I like to say, what products and services do you use, and are your friends using those? And then also looking under the hood. So everybody has an iPhone or an Android phone, but what makes that phone work? Right. So another theme is the cloud, right? So everything is in the cloud now. So WCLD is a ticker for cloud ETF, or Sky, SKYY is another one, but those are focused on cloud companies. But what are cloud companies specifically? Well, they help make your phone go from your app like Zoom obviously everybody is Zooming, so that's been a major trend. But what's behind that? So there's different companies that make the web work easier, like Akamai technology. They make it smoother so the data goes through. Or a company, we'll talk about ticker symbols, Datadog, DDOG, or Fastly, which is a stock, FSLY. And they're actually behind the technology for TikTok, making the TikTok app work. But more importantly, that's kind of one side. The other side is, well, where is the cloud? Do I look up to the sky and the stars? Is it up there? No, the cloud is not up there. The cloud is real estate. So there's real estate companies. One's Equinix, CoreSite Realty. There's a bunch of them that are out there, but what they are is data centers. So in those data centers, they connect the internet. They connect everything. So their customers are Amazon. Those customers are Google, Sony, the PlayStation, Xbox. They utilize these people for growth. So these are some people behind the scenes, and these guys are growing tremendously as people utilize more of the internet. As we move to 5G, the more data, the more it moves. So that's kind of one component. And the other component is, well, what are these machines inside these data centers? So, a lot of the semiconductors, which is another good ticker, SOX, the SOX is the semiconductor index, kind of interesting. So these are different areas kind of behind the curtain as well, or some trends that people might not realize, because you hop in your car, but you don't know really how it works, right? So it's kind of the same thing with your cell phone.
Within the COVID sphere, there's been a lot of consolidation, specifically in the retail space, as commercial real estate's had a tough time. And I just saw that Ulta has struck a deal with Target to have stores within Target stores throughout the country. Can you talk a little bit about that?
Yeah, that's an interesting one, because even though you're inside, you're still online and you're going to still be projected out to the world. So you're going to want to have your ultimate beauty shown. No pun intended there for ultra beauty, but you can be on Snapchat and you have your filters and your screens, but hey, you're still going to want to have your makeup done, your hair looking well. So, that vanity space is a good space, and probably a great move for Target, and definitely a good move for Ulta. And that's, one of the stocks I have my clients in.
Nice. Do you see a lot more of that happening, or what trends do you see as folks are remaining at home and companies are having a difficult time keeping their commercial real estate footprint?
Yeah, well, it's tough. I mean, you see that with the malls and such, and they're trying to reinvent themselves to put condos into mall spaces, and prior to that, they were struggling as well, and they were trying to put event places such as Dave & Buster's, and trying to make the mall a place to go for an event. But now it's kind of accelerated again. So, I mean, only time will tell who's going to survive and who's going to thrive. But you definitely need to have an online business as well.
Well, Rich, we're going to have you back if you're up for it. Once we are, we'd love to have you back frequently. In addition, once we are moving out of COVID, would love to, which hopefully is sooner rather than later. I should knock on wood. Sure. But but I can't thank you enough. This has been fantastic. And again, Rich Lopresti, who is a principal at Milestone Asset Management Group, and his email address will be in the show notes, as he stated earlier as well. And please stay tuned for another episode of Win the Future. Thanks for listening, and we'll talk to you soon. Thank you for listening to the Win the Future podcast, sponsored by the strategic communications firm, A Better Campaign. Make sure to visit our website at abettercampaign.com/win the future. Please don't forget to subscribe to our podcast on Spotify, Apple Podcasts, Stitcher, or wherever you get your podcasts, and share it with your friends. Thank you for tuning in. Please tune in again next Thursday for another episode of Win the Future.